stimulating information and conversations to have today. So welcome to all of you. My name is Libby Smith, and I am a partner at Accounting for Success. And I have a team of people here today that are going to be presenting our third in a series of 6 workshops on what we're calling GPS for Entrepreneurs, which stands for Growth with Purpose and Financial Savvy. And normally, Aaliyah from the SBDC is up here to welcome all of you, and I'll speak for her today on behalf of the SBDC. We really appreciate them giving us this space to be able to present. And I think a lot of you have used SBDC for some of your educational programs. So thanks to them for that. Also, I'd like to thank Larry. Where did Larry go? Larry must have stepped out of the room for a minute. But Larry and David are both with U.S. Bank, and U.S. Bank very generously contributed to funding this. So that's why everyone's been able to attend for free. So hats off to U.S. Bank. So all of us together appreciate entrepreneurs. It's really who we love working with, and we love to have owners that can be really strong financial leaders of their companies. So that's our motivation and the interest that we have in presenting this program. In front of you, you're going to see an agenda. We're going to be able to share some stories with you today. We're going to have an exercise that we'll start you on. That'll be homework. We'll have plenty of time for questions and answers today. And finally, at the end, we'd really appreciate your evaluation because that helps us improve. As far as rules of the room here, if you need to step out to take a call or whatever else you need to do, it's all casual. These guys will probably loosen their ties pretty quick here because I know none of them really like wearing them, but we know that's important. So with that, I'd like to welcome the rest of our trusted advisor team today. And I'd like to invite Lonnie to introduce yourself and explain, what is it about this kind of work we all do with entrepreneurs that really excites you, that, brings that alive for you?
You guys don't mind if I sit down, do you? I'm Lonnie Woodley. I'm the managing partner of our firm, and I think the biggest thing that I've loved about what we do or what we can help clients do is to see the impact that it can have on your business to grow. Everybody's about growth. There's no doubt about it. You can't just be in business just to stay stagnant. And the exciting things that happen when you've been in the business, working in it, when you step back and look at some of these things like fraud. It's a big thing. It happens. It happens in the smallest ways, and you just have to be able to detect it. When you can prevent something from happening, that in and of itself is a success. And that does create some excitement. So I'm very excited to be here. If you guys have any questions for us, please let us know.
And thank you, Lonnie. Next, I'll hand off to another partner that I work with, and that's Dennis Smith. And Dennis, introduce yourself and what you love about working with entrepreneurs.
I need to stand up and sitting down too long. The whole notion of helping entrepreneurs is, for me, it's helping set them up so that they can leave their business in style. And that involves choosing the right form of corporation, having a plan, choosing the right kinds of agreements to have, and all the different aspects of forming a business that's valuable. Being able to identify what are the value drivers so that the owner is sitting in the chair of power to build a powerful and a very valuable business. Libby?
Great, thank you, Dennis. And I'll just explain too, as we're introducing the Accounting for Success team, that my role at Accounting for Success is that I'm our QuickBooks guru. And as you know, about 80–90% of small businesses anymore use QuickBooks for their accounting package. And all of you realize how, what a foundation that is for your business. And you're going to hear today how important it is to know how to use your accounting system in a way that helps you prevent fraud. So yeah, that's the experience that I bring to this discussion today. So I would now like to hand off to Larry Callan from U.S. Bank. So Larry, it's your turn.
Thanks, Libby. It's our honor and privilege to sponsor this series of seminars. I've worked with small businesses almost my entire career. And it gives me the opportunity to connect with people, to support them in their endeavors. I get to learn something new every day. And that's just a thrill for me. And I can connect people and help them grow together. And I have the privilege of supervising a team of 10 small business specialists from downtown Denver out to Boulder. And it's just a kick, helping people grow their businesses and be successful. Unfortunately, I'm a stand-in presenter today. Our treasury management person that prepared this and would be the real expert was unable to attend, but I'm happy to go over some of these issues with you. I've also got Dave Rutherford from our Elevon subsidiary that's going to help me present, and he'll talk about credit card fraud and some other things. And so thank you for being here.
Yes, and David, why don't you explain a little bit about what you do and what just really gets you excited about working with entrepreneurs? Try to contain yourself, okay?
Okay. Well, first of all, I did own and operate my own business for nearly 20 years. So entrepreneurial from the start, from the core. And then we sold and I transitioned to working for U.S. Bank. We competed with them on a number of things over the years. So good place to land after we finished that. I'm a U.S. Bank employee. U.S. Bank owns Elevon, which is a subsidiary, wholly owned, and which is a credit card acquiring organization at its core. We do a lot of other things as well. But the size of that organization, worldwide, we're kind of swap back and forth between number 3 and number 4. We process over 70 to 80% of the world's airline, hotel, and hospitality transactions. In addition to, we're the largest processor in the United States. And so U.S. Bank purchased that business probably 10, 12 years ago now. What gets me excited, especially having been a small business owner, that's what I get to do every day is work with small businesses. And every small business needs to get paid. And that's what we help with.
Now that, we're happy to have you here and to be able to share all the experiences that you have. So I want to introduce and remind you of all the goals, the objectives we set out for this workshop today, because it's really important. Each of the 6, we're bringing to you like the creme de la creme of these topics, because we know your time is precious and we want you to really take home the things that are most important for you to pay attention to. So today, we're going to work with you to identify the vulnerabilities that you have to fraud in your business. We know it's an electronic world, there are a lot of vulnerabilities. Number 2, to create internal controls to put into place to reduce fraud in your normal day-to-day operations, and that's going to be the exercise that we work with you on today. And then 3rd is to develop an action plan for your business that minimizes the risks for fraud. And out of that exercise, you will take away some things to actually go home and implement in your own business to help you prevent fraud. So to kick this off, first thing is to ask you and to get you participating, because participation is the key to your success. But what's your experience with fraud in your business? What lessons have you learned? What do you have to share? I'm going to share some stories later that are actually a little embarrassing to tell, because you think, wow, I shouldn't have let that happen. But what have you seen happen in your business, or maybe friends' businesses, or lessons that you've learned about fraud? Okay, yes, it's David?
John.
John, sorry.
I've worked in the service industry for, still doing it part-time, but, and doing my business now. But in the service industry, I've seen people steal stuff from registers and some drawers come up short.
And lessons learned from that?
Never to steal money from the drawers and making other people short.
Exactly. And from a manager position, have any of the rest of you experienced this kind of situation in your business? I owned a retail business for about 10 years, and this was a huge thing. And it's about paying attention every single day about counting those drawers and holding people accountable. So that was my lesson learned when I had those kinds of things happen. How about the rest of you? Have you had any kind of situations in your business where you've experienced that? Allie, what have you discovered?
We had an employee about, 6 years ago. We have a refrigeration company, and so our guys have trucks and they have gas cards for their trucks. And his gas prices went way up, and it turned out he was just filling up gas and selling it, and filling up containers of gas and selling. I mean, random stuff. But so he just kept on swiping it
Wow.
for friends, and
Yeah, pretty bold.
Yeah.
How long, so as a management team,
it took a
how
long
long
time
did it
to figure it out.
take you to figure it out?
It took a long time to figure it out, and we didn't figure it out until the difference between everybody else's driving and his driving was really significant. So we could have, still, even going back, we may have missed the gradual.
The curve,
the,
yeah.
the trials, checking to see whether or not we were noticing it. We probably missed a good amount of it.
That is such a key, because there's this element that you have people you trust. You think you might get a hint that something isn't quite right. You tend to not really trust yourself, and it can really take time.
Yeah.
So paying attention is to your credit. I mean, that could have gone on for years
Right.
that you didn't notice it.
Right. If
So,
he hadn't done, he hadn't needed a lot of money there at the end,
Yeah.
it could have gone.
and that's what happens. It's kind of like they'll nibble a little bit more, and then at one point they often get bold, and then that makes it a little bit easier to see. So,
Well,
well,
what's
thanks.
very interesting is white collar crime in general happens, well, let me ask a question. Do you think it happens in big chunks of money or little chunks of money? Absolutely little, most of the time. And it happens to people that are in your office that you actually believe you can trust them a lot of times. And it's tough because there's a lot more that goes out the door than just money or inventory or something. It's a lot of what you've invested in a long time. And there's all kinds of statistics that say that it's a little bit each time. And sometimes that goes unnoticed for years.
And the stat that astonished me when I had my business, and I'll share my story with you on that, is that by far, I mean, nationally, by far, there is more internal theft than there are people that come in and, steal, from you, like at a cash register, or even take your inventory. It's way higher because of the people that you trust to have as employees. So that was real eye-opening to me as well. So anyone else have a story they just need to share? Got one?
Well,
Yeah,
I
go.
was gonna say, to your point, my uncle built a business from his garage, and kind of the success story built it and into a multi-million-dollar industry, and has done very, very well for himself. And for about 25 years, he's had a partner. Well, it wouldn't be a partner. He was the owner, and then he had this as a president who kind of ran alongside him. And as my uncle, his health deteriorated a little bit, and he took steps back from the company, the president really ran the helm. Unfortunate story, he ended up passing away from cancer, but after he passed away, the accountants went in and found out, and it turns out that he had embezzled millions over the years. But it happens, it was always little chunks over time, and it was the person that was probably the most trusted person within that entire organization, which was the president, who was there for decades. And so it was a good lesson to me. We work a lot with small businesses, and typically those tend to be very, very well trusted people who you're intimate, you have them for parties. You don't want to be looking at everybody like they're a thief, but you do want to put in safeguards to protect people from themselves a lot of times.
Good point. Mary?
Yeah, talking about protecting themselves. This one company that I used to, I worked for them, and then this happened later. The office managers had access to pretty pretty much everything. It was a small investment company. And she took the checks to the bank. She did pretty much everything. Her mother got sick. So her mother had medical bills. So she was gonna borrow money to help with the medical bills. And then all of a sudden it kind of got easy, so she borrowed more money. And then her mother got better, and then she decided that she and her mother deserved a trip to Hawaii, so she borrowed. So it's like when she got away with a little bit, she realized how easy it was, and she somehow felt justified because she had a sick mother to do all these things.
Mhm.
So because she had that opportunity to do it, and then
But-
combined
And
with
Mary, that's the really
Yeah.
best word. It's that opportunity. And as owners of businesses, our job is to really minimize those opportunities because they do come up, and it's astonishing how people put themselves as,
just justified.
gee, I just kind of deserve this at
Yeah.
a certain point. And that can be dangerous. Dennis? Or-
I'm sorry, go ahead, Dennis.
Yeah, I'm just going to mention that there's really three things that are currently, that are thought of as being embedded in just about any embezzlement. And one is motive, and Mary, like some kind of bills or gambling habit or something that that can present itself if we're looking for it. And the second one's opportunity. So we have motive and opportunity, and opportunity is usually not having the systems in place or not using the systems and monitoring what the information's coming from the systems. Those are the most common pieces, or not separating duties, or some of the things we'll be talking about later. So we have motive and opportunity, and the third one is rationalization.
There you go.
And the person who is embezzling has some way of rationalizing it. You know, I'm not being paid enough, or the owner needs it less than I do, or whatever. But the combination of those three are all trigger points that we can, if we pay attention, gain a nose for and start listening to.
Well, and Lonnie, you work, I mean, part of Lonnie's expertise is in what's called forensic accounting, so.
Yeah, I mean,
Sure.
it's very interesting to hear the statistics that are out there for people who do commit fraud. And you would be amazed, no, I don't think you would be amazed. It's probably actually, the way I hear everybody talking, you do understand it, that it is those most commonly trusted people. It's the people that do have access. It's the people that take a little bit at a time. It's just amazing how they do justify it in their own minds because they think they're owed it a lot of times. So, and it could be a condition, meaning that in their life today, something tragic is happening, so they need the money, or they need something. And there's signs where I went through a forensic course, and there's signs that you can use to look for fraud that you don't even know. Now, the best answer is the safeguarding. The best answer are the internal controls that we'll talk about a little bit.
Just real quick to add, you know, that's essentially what we did. We provided a point of sale system for hair salons. So Supercuts, cost cutters, Fantastic Sams. And I did that during the area where a lot of them were switching from cash registers to point of sale. Point of sale has all those things built in, not only to help prevent, but also track. And it wasn't uncommon that a lot of hair salon operators would see an increase of 25–30% in revenue
Oh,
after installing a
gosh.
point of sale.
Isn't that astonishing? Wow.
And in our own business, we had a trusted bookkeeper that was with us for 5.5 years. And one day she never came back to work. And we did quarterly auditing. We had a CPA firm that would do the things that we didn't want to focus on ourselves, but knew we needed completed. And the month prior to her missing, there was $6,000 missing as well. So.
Oh my gosh, wow. Well, and something to address the thing about motive too, in interviewing people, you know, something I learned too, it is important to find out a little bit about what's going on in people's lives because there can be kind of clues, and sometimes you're just setting yourself up. Welcome, find a seat. That can be clues that we sometimes don't want to pay attention to, but can be very important. Well, we're going to be sharing some more of our experiences from the trusted advisors in a little bit here, but first we're going to be hearing from the trusted advisors, and then we're going to go into some electronic fraud information. So welcome, Larry. Take it away.
Thank you, Libby. So we'll talk some about some current trends, liabilities, types of check fraud, what the bank's role is in fraud prevention, and your role. We'll go through a Q&A. So first of all, some statistics. And sadly, when we share with clients and prospects that 2/3 of organizations experience an attempted fraud, it doesn't seem to ring true very often with them. You know, it's not going to happen to me is something we hear very, very often. And 28% of organizations saw an increase. So, and check fraud is still the dominant source of exposure for most companies. %.
And Larry, when you say check fraud, though, what does that mean? What does check fraud mean?
Well, we'll get into some specifics, but basically it could be check washing, it could be taking your routing and checking account number. And as simple as an employee has a past due utility bill, they call up the utility, give them the routing and account number, boom, it's done. That's one of the reasons that payroll checks are the biggest source of fraud. It's just access to your routing and account number. You can't count on other places to protect you. You have to think about who's got access to that. People can wash a check, make an image, wash out signatures.
You know what's amazing, and this is just a personal experience. My wife had her purse stolen once, and there was one check in the checkbook. They made checks. Somehow they made checks that they had cashed with numbers that we had no clue. We didn't. The bank had to
You just
absorb it.
mail order checks. Yeah, just order some new checks on that account.
They didn't even do
Change
that.
the
It was that day that they were
That
writing
day.
checks that were they're so sophisticated with that on check fraud that
Yep.
it's something to be concerned about. No doubt about it.
So, you know, and it's significant. Typical loss, $23,000. This is just from the survey. And that survey was by the Association of Financial Professionals that does this on a regular basis. So this is an industry type data. There's just kind of a trend over time. It's interesting that 2009 was the peak. It's coming down some. I think part of that is that people are paying attention and doing a better job of trying to prevent it. But that's still, you know, 2 out of 3 odds that there'll be an attempt on your business. That's high enough for me to take some action. So what are the types of check fraud? Signature and endorsement forgery. You know, it has to be convenient. They alter the checks. They counterfeit the checks. Or there's direct embezzlement. So
Larry, when you hear people talk about like laundering, you know, money laundering, how do checks fit into that scenario? How does that work?
checks and money laundering. Money laundering is trying to take illicit funds, run them through the banking system, and make them appear to be legitimate. So that happens in a variety of ways. It's not directly tied to check fraud as much. It's a different kind of risk that financial institutions face more than individual businesses. But sometimes legitimate business is used as a front for illegitimate activities. So if I have a restaurant owner that's bringing his deposits in a brown paper bag, everything is cash, I'm probably going to have some questions about the legitimacy of all of those deposits. But that's a different issue and a concern, that we have to face. I need to back up a little bit because it's important for you to know that the reason we focus on paper checks is that ACH fraud only happens in 14% of the organizations. So using the automated clearinghouse to transfer money in 2 to 3 days is in itself a way to reduce fraud. It remains one of the most favored payment mechanisms from a fraud control perspective. Electronic check conversion still has a low incidence of fraud. That's, taking a picture of your checks, making a deposit that way. The fraudsters are always focusing on new ways to capture and work through technology. So, it's all about checks as far as the single biggest exposure today. So who's liable? There are standards in the Uniform Commercial Code that are applied in terms of determining liability. Typically, a bank is going to protect you on the first instance, but that's when the responsibility shifts back to you. I have a client that has a fraud occurrence. We're going to have a conversation about how to prevent that. You can put in some electronic controls, you can change to a new account number. If you fail to take steps to control and prevent that fraud, you will be assuming the liability of future fraud. So it's serious after it first happens. I think an ounce of prevention is worth a pound of cure. So one of the typical things that we do with clients is set up multiple checking accounts. If you can segregate your funds and who has access to them, that's really the first inexpensive, easy process for you to help bolster your controls. If your receipts come into one account, you don't write any checks on that account. You block ACH access. You've protected the source of your revenue. That's where the big money is. If you're writing payroll checks, AP checks, everything out of one main account and all your revenue comes in there, that's the highest level of exposure. So, something as simple as segregating your accounts by purpose. Many companies will fund their payroll account only for the payroll amount, only the day before payroll. Some companies do that with their payable accounts. But that's something that you can do. But there are rules and laws, and if you don't take it seriously, you could end up assuming some liability that you really don't want to.
When you say segregated accounts, do you mean a totally different bank as well?
No, just a different bank account. Yep. And just think about the access, how the money comes in and how it goes out. We'll talk more about that, but commonly separating payroll accounts is really important because of the high incidence with payroll checks. But, that's just one example. I've had clients that separate their electronic deposits from their credit card processing to one account. Again, probably because that's where a bulk of their sales come from. Yeah.
So like what you're talking about, really is having kind of a main cash concentration account and then having a separate account for et cetera. Can you talk a bit too for small business owners, the cost of that versus the opposite, which is to have one or two accounts?
Cost is an issue, and we try and focus on a cost-effective solution. You should look at a cost-effective solution. Concentration accounts and sweeping money electronically and automatically, you're going to be in the $100 to $200 a month range to have those kinds of services. Just a broad ballpark figure. Again, per account. I'm not a treasury management specialist. I'm not a deposit account specialist. So if you want to take the initiative to control the transfers yourself, and just have 2, maybe 3 accounts that you have sufficient volume, probably very, very limited fees that you would pay on that kind of an account structure. So your ability to control it yourself versus having it automated is kind of the key to staying with a smaller business type of account structure. Once you get to 2, 4, 5 million in sales, then it starts to make sense to look at something more because you'll have more staffing requirements and you'll be spread thin as far as your ability to manage things. So, great question.
I'm sorry, one more question along those lines. What is the automated sweeping that you're talking about? What is that?
Okay, so there's different types of sweep accounts or concentration accounts, but let's just say that you have a payables account. We would call that a zero balance account. So whatever balances are in that account would be automatically moved to a concentration account every night. The next day, the checks that are presented for payment on that zero balance account, the amount to cover those will be swept back from the concentration account.
Interesting.
And you can access, sorry, something,
Yeah.
with CPA accounts, one of the benefits of it is you can see the checks that are being presented. If there's an issue, it's a way for you to kind of look ahead of time, you could maybe stop and pay the check.
Yeah, it functions from a practical standpoint, much like having positive pay or reverse positive pay. I'll get into those and describe those a little bit later. When interest rates were higher, 2005, 2006, it made sense for companies that were accumulating significant amounts of cash in their revenue account to sweep those into an interest-bearing account. So every night, you'd go to zero, you'd earn interest on those deposits. When rates changed, it just didn't make sense economically to keep a lot of those in place. And I, for one, we were very proactive in getting with our clients to say, it's great for us, we'll take the revenue, but you should know you're not going to earn any interest, and so there might be a better way to manage your money. Larger companies with larger borrowing will actually apply excess cash against their outstanding loan balances overnight and save interest expense on their borrowed money. So that's what I mean when I say there's a variety of sweeps out there. You got to make sure the juice is worth the squeeze. None of it's free. So what are banks doing? We've got some pretty sophisticated systems in the back room. So during the automated processing, a lot of fraud attempts are foiled and a lot of issues are brought to bear. There's always something new. But as good as banks are in their processing, that can't substitute for the care that you need to show in how you set things up and control them. So we do require customers to take action if a fraud occurs. So there's some things you can do about the checks themselves. You may be familiar with some of these things, the watermarks, the microprinting, fluorescent fibers. It's not just a plain paper check printed off on your multi-purpose printer. There are things you can do if you're a high-volume check issuer. And this is where we're going to spend time on the exercise and really help you think about your internal control structures. Separation of duties is
So
key.
Larry, before you get into the internal controls, you hear a lot about dual signatures or some of even the things that you're talking about with watermarks. How much should they rely on the bank to catch the things that are put in place, like dual signatures, watermarks obviously it's got to clear the bank for it to hit them. So how much should a company really rely on the bank to detect that fraud?
My personal bias, I'm not making an official statement on behalf of my employer. My personal bias is that should be a secondary or a tertiary line of defense. I really advocate that you protect yourself first. And these are a good safety backup.
Yeah, and I think the one thing that we do as business owners too much is expect somebody else to take responsibility for what we should be doing. And that's where Larry's getting into the internal controls. And it's nothing negative about any banks, but dual signatures, there's no way that when those checks are running through the machine as fast as they run through the machine, that they're going to catch it. And you shouldn't really rely on that, even though when you hear about internal controls, that's one of the ones that you say you should have. But watermarks too, it's just impossible for the speed of transactions today to make that the one key catch.
Yeah, I don't think when you sign an account agreement with a bank, it's going to say, we will protect you against fraud. And it's certainly not your first line of defense, so great point. And which is why we talk about this. It baffles me sometimes the conversations that I'll have with a business owner about, so who signs your checks, who opens your mail, who has authority to move money from your bank accounts, who takes the deposits in, and we'll have a trusted bookkeeper who's got the keys to the kingdom. Literally, they can do more than the business owner. Okay, so that, that's something to seriously think about. And most of the stories around fraud deal with somebody trusted somebody too much. And you know what? I don't think any of us are that perfect to judge character.
Yeah, I've got an embarrassing story that I actually was a part owner of a business, and there was a bookkeeper that we thoroughly trusted, and didn't really think about things until we started getting calls from vendors saying, where's our payments? Where's our payments? Why aren't we being paid? And what happened was that she was writing checks to her boyfriend and posting them so that we saw them in financial records as payments to vendors. And it was probably, I don't remember what the number was, $40,000 later that we caught her. And, they didn't have the money, so it's not like we can get that money back. And you have insurance, but the insurance has a deductible. But anyway, it's that trusted person that you really have to have some oversight on, no matter how much you really trust them.
Quick story on one of these bullet points, actually two things. You do have a responsibility if there's fraud. You've got to notify the bank promptly if you suspect fraud. If you go outside the reporting deadline, don't expect the bank to, out of their goodness of their heart, say, oh, we'll stand that loss. You need to reconcile your accounts. Reconciliation is an important function. You shouldn't give that to the person writing the checks, unless it's you. But background references, I just heard from someone about a month ago, hired a new bookkeeper. Well, we didn't wait for the background check to come in, and guess what the bookkeeper was doing? Processing payroll, had access to every employee's social security number, name, address, personal information, access to the accounts. Background check showed a conviction for identity theft and fraud. Is that a scary situation to be in? Okay, I talked real briefly about positive pay and what that does. So positive pay is you communicating electronically to the bank, these are the checks that we processed, these are the amounts, the payees, and then when presented to the bank, it can be verified. So that if someone comes to the teller window, has a check that's been altered, and they try and present it, they won't be able to cash it. Reverse positive pay is where instead of sending all of the check information to the bank sends you a list of the checks that are presented electronically, and you have the responsibility then within a window of time to confirm, yep, those are the checks the way they wanted them to be presented, the way they were issued. You can block ACH transactions, positive pay. There's just a lot of tools available that are pretty cost effective. But again, account structure can help a lot before you even get into that expense.
How does a small business, I think these are really cool options, just in terms of work. How much more work that would create. And how does a small business cope with that extra overhead time?
Small is a relative term.
Right, true.
Okay, and your risk exposure has to be part of that consideration. How many dollars you're talking about, do people have access, overall back up and say what's the risk. start with your account structure and those things and the separation of duties, quite honestly. And a lot of this, it's, we're talking less than 15 minutes a day. It's electronic, but it requires you to take some action to pay attention. So with that, remember, it's a crime of opportunity, to Dennis's points earlier. If you've been targeted, if you've foiled some attempts, you're on notice that someone has got some of your information, and you should take some action to protect yourself. So it takes a lot more time and resources if you have a problem to fix it than it does to prevent it.
What if it's a situation, Larry, as with Target some months ago, and the customers of Target being, the credit card information being compromised?
Roy, I need to pay you for that perfect transition to David's topics, but we do want to get into and exercise a little bit.
And we make sure we cover that.
And we
because
will
we're
cover
gonna-
that.
Yeah, we're gonna take a little interlude here, come back to electronic frauds. Thank you, Larry. We wanted, thanks for sharing with us about your personal fraud experiences, and we thought it would be helpful to you today to hear some specific incidences from the advisors that are here today. And I'm going to kick that off because besides working with clients over the last 20, 25 years, helping them with their QuickBooks and being sure they have accurate, timely reporting for their companies, I also had my own retail business for about 12 years. And at one point I actually had 5 retail stores up in the mountains here in Denver. So, I knew how to manage, I knew these problems, and certainly in a retail business, again, counting the drawer, being sure that your drawers tie up, that's nothing but like a warning system that, keeping an eye on things and what's happening. But I have to tell you, in those 10 years, I had 3 really major theft issues, and you would think, with dealing with that so much that that it would be sort of obvious, but they come so unexpectedly. And again, I think the key is about the trust that you build. When you work in a retail store and you've hired people and they've worked for you for years and years and years, they're like family, and you really do have a high level of trust. The first really big thing that happened, it was at Christmas time, and in retail, Christmas is your time, where you really bring in the money, and that day before Christmas, like Christmas Eve day, is usually always the biggest. And one year we decided to have a Christmas party right on Christmas Eve. And my husband and I left the store to go to the party. We left our manager behind to, put the money in our protected place that we had, so there'd, be no issue there. But then the next day we came in and went to make that deposit, and all of that cash, it was probably close to $20,000, $15,000, $20,000 was gone. The place where we would usually keep the cash was totally empty. Well, we went through the whole thing of, how could that happen? And employees were like, again, you just go through all of this. But what happened is that manager kind of disappeared the next day. And what we found out was that she had family connections in South America and had actually been accused of running drugs and doing all kinds of things that we had no clue about. So again, it was gone, that was that, live on. But very interestingly, about 5 or 6, 7 years later, in a different store, had exactly the same thing happen on exactly Christmas Eve. Same thing, different manager, someone who worked for us for years. They didn't have any idea about this other thing ever happening, and then it happened again. So, you think you'd like to learn your lessons, but again, it's this relationship that can be very problematic. And the third time that was just really pervasive was having an employee that was stealing from us over time. And what I want to mention with this is we were doing our profit margin numbers every single month. We knew what those numbers should be, and every month they just were lower and lower and lower, just not much, niggly little amounts. And we think, wow, we must have not counted inventory right, something didn't happen. But along the same path, we were seeing money missing out of the drawer. We were seeing This was the era of the sex phone lines, or phone calls. Remember how people could call in and make those sex calls and you'd have like $100 phone bill? Well, that was happening. Just all these crazy things happening. And then somehow, it got so bad we had to fire everybody but the manager. And in 1 month, our profit margin, which would normally be like 50, 55%, it had gotten down to 30%. I mean, we couldn't pay the bills anymore. That month, it popped back up to 55%. We figured out what the problem was. A person had been bringing her friends in to steal things. She left and went to work in another store, and we were prohibited from sharing with other owners that we suspected her of theft. And she got in our face about it. She says, if you tell anybody, I'm going to sue. So anyway, about a year later, we heard that she was caught with 40 pairs of shoes sitting outside the retail store that she was getting ready to load into her car. So you do have to pay attention when these things happen, and you have to kind of find ways to, kind of band together when those things happen. So Lonnie, being with the forensics.
The interesting thing is we have an opportunity to experience some things that are very unusual. And I can tell you that we've been through a lot of them. But one of the most unusual things is when you trust somebody so much that you marry them and they steal from you.
Yes.
And we're not talking $10,000, we're talking $400,000 or more. And when you have that happen to you, what do? You trust, obviously you trust the person, but we've been in cases where the spouse has stole from the business.
They have a gambling problem, shopping network problems.
It was incredible, and it was every little way that they could take money out of the account. And it wasn't caught because they were in control of everything. I had another interesting situation as an auditor. This one I think is a little bit because the owner was the one that was committing the fraud. But we were doing inventory of a grain elevator, and I don't know if anybody knows about grain elevators, but you've got corn in a grain elevator. And you have to count the cones, you have to measure it as an auditor. But it was interesting because there were like 10 elevators stacked together, or grain bins stacked together, and they were all connected with a tube. And it was strange that once you finished one, the tube started moving, or the grain started moving. You didn't realize that by the time you got to the 8th one, it was full. And luckily our auditor said, I want to go back and look at this one because I don't think I measured the cone right. Went back to the first one and there was no grain, there was no corn in it. So they were just moving it back and forth. It's really interesting to hear some of the stories that go on just to commit something that is, in this case, they were very leveraged and they had to have a good audit. And when you go through that kind of pressure, you just don't know what people are capable of doing. And that just relates back to your spouse stealing from you, which is very incredible, and it's sad, but it does happen.
Yeah. And both of the cases that I know it's happened, divorces happen. I mean, it breaks up whole families, and when you have a family business, that's just like a double vulnerability to have that happen.
What's the difference between fraud and theft?
Well, I think actually theft is almost a subset of fraud to a certain degree, because fraud can be, but they are different in legal terms. The problem that you run into is it's really all around how severe it is to get to that whole fraud question, because fraud is the nasty evil. It's interesting because we do forensic accounting, and we have clients. I've had several clients come and say, I think our CFO or our controller is stealing from us. And what I hope to say, when I walk into an engagement like that, I say to them, I hope I find nothing. Because if I find something, you've got a bigger problem. And a lot of the times we don't find anything, to be honest. But that suspicion needs to happen earlier on, by the systems that you have in place. And we'll get into some of the internal controls that can help you. I mean, it's simple things as owners that you get the bank statement unopened, and you review the banks. You understand the bank statement. You understand different things. You review transactions. You review check registers. It doesn't take a lot of time, and it isn't always that you might find something. It's more that people know you're looking at it. Because some of that goes, an ounce of that goes a long ways.
When you have a process and a procedure that is followed meticulously, that's what I learned in that business too. It's almost like it's like an invisible shield, because the people that are looking to come and steal, they're looking for weaknesses in those areas.
Well, and employees, I guarantee you change something or you put a system in place, there are employees out there, not to be the ultimate pessimist, but there are employees that will find ways around that. So one of the other things that you do is you do surprise type of audits, if you will, internally. You can do those. Or you change something. Or you force somebody to go on vacation.
Yes.
That's a huge thing, because people who commit fraud don't want to leave. They don't want somebody else looking at their stuff.
You have to be gone for a week, continuous.
Yes. Some companies, require 2 weeks.
That's the way it was when I was in your business.
Yeah.
It was 2 weeks, and it wasn't just being gone. You couldn't access email, you couldn't take your BlackBerry, you couldn't do anything business related. It was a fireable offense in our firm if you did.
I worked for a bank too, and we had to be gone for 2 weeks. Together, 2 executives, yeah.
Right, and usually, you're handing that over to someone else too, who's, gonna be doing your job and noticing if there's irregularities, so it is a great firewall.
And the thing is that the justification factor is huge, and I don't want to take up too much time, but in another life, years ago, I was a manager, and I oversaw a team that worked, in essence, in a call center, and their job was measured by the amount of calls that they made. And so that was very easily tracked. You could track on spreadsheets. And so everybody knew if I had this many calls during the day, I was good. Now, they had other production measures that they had, but that was kind of the daily measurable, was the calls. So it got very interesting that, especially employees who've been there, calling it boring. And so they would find creative ways to figure out different ways of kind of faking calls, hitting the redial button, calling their friends, calling the radio station 50 times in a row. And it got to the point where they would find creative ways, and you would have to go back and see. And I remember I had one employee who made 1,100 calls in a 3-week period, and 980 of them were to the same number. Poor person, whoever that was. But the thing is that unless you're paying attention and you know whatever it is, now this was just, I equated it to stealing time. You get a paycheck, you're not doing anything. But a lot of times, those employees that are most familiar with their job will find the ways that those who are not as familiar with it, how to steal, how to, whether it's the gas card, whether it's, making fake phone calls, whatever those are, and unless there's specific checks that they know I'm going to be checked, there's ways, and there's ways to prevent it, that almost protects them from themselves. Because I had to let many people go with families that tears in their eyes, I'm sorry, I know I shouldn't have. You shouldn't have, but you did. And, it doesn't mean they're horrible people. It means they made stupid decisions over a period of time, but, how can we help that too? And I think that's a big thing.
Really good point. Really good point about unfairness to the employee. And I use that frequently. Is it fair to put someone in such a situation that they have overwhelming opportunity and temptation? Why would you do that?
Yeah, there is one simple thing too that actually helps in production is cross-training. Make sure that you have people cross-trained in every position really, but mostly on those critical financial ones, because then you can have somebody step in and see if it's being done, and then you can have somebody replace them at any point in time, but you also then have an audit check if you have somebody cross-trained, I guarantee it. And that's why most employees don't want to cross-train that are actually committing fraudulent.
I was just gonna say, when they start getting defensive about it, there's something.
Exactly. And those are simple things. So those are really things that an owner, if I'm in a medium business, small business, I would want to have anyway. In fact, I would want, depending on the size of the business, I want somebody that I know is in the management team to understand every job activity too.
And Dennis, you got a point here?
I'm just going to bring up a couple of points on dealing with companies that have a bit more sophisticated, they already have controls set up. And a couple of examples, I've been in the public accounting business for 4 decades, and one of my periods was an auditor, and we were looking for, this was at an insurance company, a casualty insurance company, and they did both the sales of insurance and also the adjustment and claim settlement. And what we stumbled onto was an adjuster that had formed his own companies who were suppliers, and he also would go out and be the adjuster for the claim. So he would point to suppliers and make recommendations to the customers. The net result was he had checks written from the company to pay the suppliers on the insurance claims, and I don't recall the amounts, but they were pretty doggone large amounts that were taken over time. Another one was a cemetery company, and the cemetery company had a CFO, and the CFO had the same thing, the opportunity, he had the motivation, and he had the what's the word? Yeah, thank you. In any event, he had set up he was writing checks to himself and then taking them out of the bank statement and substituting other checks. This is before we had electronic banking, but there were, the only way we ran onto that was by looking at the checks and comparing them to what was well, in any event, there was another case where sophisticated people were trusted too much. They didn't have separation of duties, and we had a significant loss as a result. Then they closed the doors to that. And one of the lessons here is this is an ongoing process. You can't just go in and say it's done. You have to take a look at all the changes that are occurring in procedures and people and continually update the process.
Yeah, it's huge, and we need to wrap up so Larry can kind of finish up here what he's got. It's great to have all this participation, and just say too, one of the things I learned is you gotta be clear as an owner, are you gonna be willing to prosecute someone when this comes up? Is this something you're willing to put in an employee manual or whatever? Go ahead and do this, we'll circle back on the internal control side to have questions answered about that, so you're clear about what your homework is.
While Larry's walking up there, though, how many people have actually audited financial statements? Anybody? A lot of people think they can rely on an auditor to catch fraud. Not if they're not specific procedures. It's very clear in the engagement letter that we do, and in audit reports that we do. An audit, a true audit financial statement is not to detect fraud. A lot of people try to rely on that. Don't do it. Spend the time on your set internal controls and spend the time on maybe having somebody help you with the internal controls. But an audit doesn't detect fraud.
I would add, we don't have audited financials at the company that I'm with now, but I did at the nonprofit that I ran, and it was an invaluable process. I would add that the auditing process was really invaluable for helping us look at our internal controls. I mean, to really break it down and make sure, especially in a small agency, that everything made sense. And there may be another way to do it, but the audit really helped for us as a nonprofit because it was a requirement anyway.
Yeah, the good auditors will sit down with you and go over internal controls, truly. And that's what we try to do, because an audit is a necessary evil. Get something out of it.
Yeah.
Really hold your auditor accountable, because they actually do know internal controls. They have all kinds of checklists, as Libby was mentioning. So it is interesting, but don't rely completely on an audit. That's like relying on the bank to catch all the fraud from a check going through. It just can't happen.
With that, I'm going to turn it over to Dave. He's going to talk to us about credit card fraud and some of the changes that are happening in the industry.
If you wouldn't mind, just take one and pass it around. Appreciate it. Thank you. All right, so you had mentioned Target. In the news, all the time you hear about different companies having data breaches. Just a couple quick statistics. When when we talk about electronic credit debit cards, is roughly 50–55% of all businesses accept debit and credit as a form of payment. Maybe not primary, but somewhere in their mix, they do. Of that 55%, 41% have experienced some sort of fraud associated with that. Whether it be a data breach, employees can also commit fraud on terminals that probably one of those internal controls, and I'll address that. But the biggest thing that's coming is the chip and pin card, or what's called EMV. Okay, I'm going to pass this around. Many of you that probably travel internationally already have a card with the chip in it versus a magnetic strip on the back, or it might be both. But I'll pass this around so you can get a kind of take a look so you can see what's coming. And then just, yeah, if that ends up with Larry, that would be great. But what that is EMV. So what's going to happen that's different today than it will be next year? One is in how the card is used, and two is what is the impact to the business owner. And so one, how the card is used is that EMV card or that chip card is designed never to leave the customer's hand. So right now you're familiar with going into a restaurant, at the end of the meal you give the waiter your card, he walks away with it and brings it back. That'll cease to happen. There's a lot of opportunity for fraud when that's out of your control. Okay, so that's one of the impacts that it will have. Two is in that chip is an algorithm. So as that electronic transaction is processed, that no two transactions will ever have the same information. So right now when you use your card, everything's the same except for the amount. That will no longer happen with the chip cards. So it'll be like every transaction is independent. Once that transaction's been used, it can't be duplicated. And so that's how that card works. And that's what that chip does to prevent fraud. One, it'll never leave your hand. Two, it will be unique. Okay. And so how that impacts a business owner is if you're not EMV compliant by October 2015, the liability will shift to you for fraudulent transactions. So if I'm a business owner, I've got an old terminal, a customer comes to me with a card that has both a magnetic stripe and a chip in it, and I swipe it rather than doing the chip, and it's a fraudulent card, Visa and MasterCard will no longer accept that liability. It will be transferred to the business owner.
Is Bitcoin going in this direction as well?
Bitcoin's a whole different topic. There's positives and negatives with that, but all electronic transactions eventually will be encapsulated like this. And so that's your businesses that accept debit and credit, face-to-face, card-present transactions. Now when it comes to I'm sorry.
How is NFC playing in all this?
The same.
Okay.
Yeah, the
Is that
same.
going to be, is there, so there's no requirement for NFC?
There is no requirement for NFC currently.
What is
correct.
NFC?
So the Apple Pay,
Wave your
the
card.
Google, where's the tap and go cards? Yeah, near field communications. So if you ever been to Canada, you'll see the women when they gas up their cars, they'll tap their purse up against the pump. That's how they pay. So because the card's in their car. So but yeah, all those are designed so that they have an algorithm involved so that transactions can't be duplicated. So if you own a business or you work with businesses that do, this is something to help them be aware of. And being involved in this industry for a number of years, I always tell everybody that I work with, I would not do this business if I didn't work for the bank, because there's a lot of less than ethical providers out there that are gonna tell a lot of stories. So, you know, as with anything, you always want to get that same story from 2 or 3 trusted partners before you make a buying decision. So definitely don't always listen to the horror stories that a lot of people will tell you.
So the change in liability, switching from MasterCard or Visa to business, is only for people who have one of these cards and it's not used. So if they have a swipe card, we
Right.
still swipe it and nothing, I mean, there's
Right.
nothing we can do.
And
at
there'll
that
be
point,
some
right?
overlap for about a year,
Okay.
but eventually there will be no more magnetic
Okay.
stripe because that's what gets copied.
Quick. Kind of a selfish question, I think. I recently bought a new iPhone, and we were in the store buying it, and my card was turned down. But I knew I had plenty of available in line to pay for it. So I had to pull another card, and that worked just fine. And sure enough, I got a text message from my bank saying they thought there was fraud happening. While one card said that, the other card did not. So what's going on there? What kind of algorithm is in place? How is a fraud identified? Even though it's new here in town, what's happening?
Right.
How is that fraud in one company not?
So there's multiple places to capture a potential situation as it processes through the different things. Because when that card's swiped, it touches the issuing bank, it touches the processor, it touches MasterCard Visa, and it also touches a clearinghouse. So at any one of those points along the line, something said, this is out of character. And so, as some banks are more conservative than others, some processors are more conservative than others, that's kind of where that potential for that is to happen.
My purchase of this phone is out of character for me.
For your activity,
The bank is
correct.
not happening.
It could be the purchase itself, could be the location, it could have been where the previous transactions were. It's any number of things.
Yeah,
Yeah, I was trying, I never called that.
yeah. When we owned our business, and then subsequently after we sold and I worked for the company that we sold it to, you know, I had a travel card from my employer. And, I mean, you know, there wasn't a state that I didn't visit, a major city I didn't visit, a rental car agency that I didn't use, and both Mexico and Canada. And so you would think that after a while, they'd just think, you know, this guy could be anywhere doing anything at any time. And more often than not, I would end up having to make a phone call and waiting 15, 20 minutes to check into a hotel, rent a car or something like that. So there is, you know, there is a lot of that working on the back end to make sure that, you know, I've never bought anything outside of the US and now I'm buying something from Pakistan. It'll, you know, probably get flagged. So that's how that works. So there's multiple layers in there. So that's the biggest component that's coming up as far as impact of business. Now there's other areas that businesses are required by Visa and MasterCard. I'm sorry.
I'm just kind of letting you know we're getting towards the end here, so.
Okay.
Do you think in 3 to 5 minutes you'll be
Exactly.
able to share all your wisdom with us?
Yep, 3 to 5 minutes, okay. As to be PCI DDS compliant, it's the payment card industry, data security standards, that's something that processors should require on an annual basis because it not only verifies your personal practices, it also scans the network from one end to the other to make sure there's no opportunities for data leaks and those types of things. And so, you know, if you're a business owner, it's something to be aware of. If you consult with business owners, it's something that they want to make sure that they've done. Because what I find very common as I review people's account, that they just pay the fee for not being compliant and think they're okay, and that's not the case.
Easier is not always better.
Yeah, easier is not always better. And so these handouts will tell you what you need to know about EMV, and then also what you need to be aware of or what's available. EMV is one, the tokenization and encryption is the other, and that's where internet-based businesses or not face-to-face businesses. But there's products and services that help that security as well. And today, the security is as good or better internet-wise as it is face-to-face. So.